Lastly, I want to talk about a really important concept called averaging in and out of trades. You'll see this graphic on screen where a lot of us don't know what to do on a regular basis. We don't know whether to buy or to sell, but most of us hit that blue button that says trade. Most of you are trading too often, and that's a real problem here. And I want to talk about something called a binary trade. Now let's just take a pause here for a minute, because trading by definition for most of us is an emotional experience. Now, why is that, Brian? Because the minute after you place a trade in any market, especially in crypto, that trade has already moved. The cryptocurrency has moved. So within 60 seconds, you're either right or you're either wrong. You're either a good person that day, you're a bad person. You're either happy or you're sad. You're either an asset to society or you're useless. That's the way our emotional brain processes it. And so that means that a minute after that trade is over, you now have an emotional relationship with that trade, okay? If it's up, you're thinking this trade might make me a billionaire, and you start thinking about the yachts. If it's down, you're thinking this trade might mean I can't pay the rent this month and my kids can't go to university or private school or whatever you want. Already you have an emotional relationship with that trade, because in your mind, it's a binary outcome, which means this: that single trade is going to be a winner or a loser when you either sell it for your gains, ideally at your 2-to-1 risk-reward ratio, or you get stopped out and you take a loss, all right? And so all of a sudden, that becomes a binary trade. It's going to be something you always remember as a success or a failure, all right? And just type yes in the chat or give me a thumbs up if you're watching me right now. Does that make sense to you? Because again, I struggled with this when I was in my 20s as a new trader. Every trade was an emotion. Every trade, I either won or I lost. I was a success or a failure. And quite honestly, that's the wrong way to be a trader. Because at the end of the month, when you're in my DeFi Market Wizards group, you post your portfolio percentage gains and the money you've made on the month. Maybe you made $10,000, maybe you made $50,000, maybe you made $100,000 that month. That's what we want to know. I don't need to know about every single trade. I need to know overall how we did. So it's time to start thinking about trades in a binary fashion and to try to conceive of this idea of averaging in and averaging out. And I want to put a screen capture up here that you can all look at right now. And you can see a candlestick chart of a cryptocurrency. And you can see here about some levels that we're looking at and some profit gains and the maximum loss. And you can see here of where we've got our gains here and our losses in, our program trades for our reward to risk ratio, okay? All of this is good. And all of this is by the book and by the strategy. But now I want to talk about this concept of averaging in and averaging out. So let's keep those same gains in mind. But as opposed to selling at our 2-to-1 reward risk ratio and popping the bottles and making our 2-to-1 gains and getting excited, averaging out of a trade means this, is that we take profits in thirds. So as opposed to selling it all at that one gain, we sell a third of it lower. We sell a third of it that level, and we sell a third of it a little bit higher. And this is one of the reasons that some of my students has been very successful on an instrument like Solana, okay? Solana spiked this month. It went way up, okay? Blasted through $100. Now, you could have been waiting for that one point to sell, or you could have averaged in and taken those profits along the way. What does that do to you emotionally? Well, let me tell you, when you take some gains on a trade, all of a sudden, you exhale. It takes the emotion out. It takes the adrenaline out of a trade because you already locked in some gains. So you can rest a little bit of easier. You know that your profit, your stop loss now, you can reduce by a third because you've already taken some profits. And the whole thing becomes more of a I am riding the markets mentality as opposed to a I have to be right on this trade. It strangely changes the whole philosophy. So the next time you're putting a trade in, I want you to try this process of averaging out on your gain by not putting in one trade, but put 3 trades in around those levels and sell a little bit earlier than you would, sell where you would, and sell a little bit higher than you would, and see how you can average out of that trade. The other thing you can do when you're putting on a position is you can average into that position. So as opposed to thinking, oh my gosh, do I have to buy Cardano now before it goes above $3? Yes or no? You can say, guess what? I'm going to buy a third of my Cardano now. I'm going to put an order in below the market by a little bit. And I'm going to put an order in below the market even a little bit more. And that way I know at least I got some of my position so I can relax. And I know I'll get more of my position if the market has a little volatility before it pops and goes higher. And that's called averaging in. And again, it's another way of getting over that psychological barrier of having a binary position. I'm either in or I'm out. This way you're always in and you're always out. And it's a way of constantly averaging in and averaging out of trades. It's what the professionals do. It means you have to have a few more things in your head and a higher quantity of stop losses and gains, but it's just a more intelligent and a more emotionless way of trading in the long run, a great way to start trading like a Terminator. And I want to share with you just 1 minute briefly from inside the Academy, one of my modules, where I talk about this concept of averaging in and averaging out. Let's look at an example of averaging out. In our original trade of buying one Bitcoin at $50,000, we had a stop loss limit order of $48,000, which correctly follows our 1% rule. But what if we decided to average out of that trade by placing 3 orders instead of 1, selling 1/3 of a Bitcoin at $48,500, 1/3 of a Bitcoin at $48,000, and 1/3 of a Bitcoin at $47,500. This allows a trader to not have their entire P&L based on triggering a single price of $48,000, and instead can base the position on a range in the market. Again, we are never increasing our risk. Our averages ensure we are correctly following the 1% rule. But what about averaging out in a profit-taking scenario? From our previous example, instead of selling one Bitcoin at $54,000, we could sell 1/3 of a Bitcoin at $53,000, 1/3 of a Bitcoin at $54,000, and 1/3 of a Bitcoin at $55,000. This allows us to not have our entire profit-taking scenario based on a single price point trigger.